How to become a reliable swing trader in crypto. If you've been in the crypto world for a while, you know that this market can be extremely volatile in the short term. Prices can surge 20% overnight, then plummet 30% the next day without warning. In the midst of this extreme volatility, there's one trading style that often comes to the rescue for traders who can't monitor charts 24/7: swing trading. Swing trading is a strategy that allows you to hold positions for several days to weeks, with the aim of capturing significant price movements within a trend. It's not scalping. It's not day trading. It's also not blindly holding onto your positions. It's about holding positions with strategy, logic, and most importantly, discipline. For those of you with a full-time job, a busy business, or a real life that can't be sacrificed for a screen full of red and green candles, swing trading could be the solution. But even though it seems more relaxed, swing trading actually requires skills that are no less demanding than those of a day trader. In fact, it can sometimes be more mentally taxing. Why? Because when you swing trade, you have to endure seeing floating red. You have to be patient and wait for your target. You have to be prepared for all possibilities, including when the market suddenly changes direction due to macro sentiment or a casual tweet from a prominent figure. Swing traders are required to be able to read medium-term trends, manage risk strictly, and most importantly, not panic easily. In this episode, we'll thoroughly discuss how to become a skilled swing trader in the crypto world. Not just theory from books, but practical approaches you can apply right away. We'll start with how to properly read charts, build a strong swing mindset, and how to adjust your strategy based on macro conditions and the fundamentals of the projects you hold. So, for those of you who are tired of scalping but not ready for long-term hodling, or for those who want to stay active in crypto despite limited time, this episode is a must-listen, because we'll break it all down. No clickbait, no empty promises, just a logical approach that can keep you profitable, even in a sideways or retracing market. Get comfortable, grab your black coffee, and let's embark on the journey to become a swing trader who isn't just resilient, but also profitable. Chapter 1. Get used to looking at the long-term time frame. One of the habits that most hinders someone from becoming a skilled swing trader is focusing too much on small time frames. This is a classic mistake. You open a 5-minute chart, analyze a 15-minute candle, then open and close positions within 30 minutes just because one indicator gives a buy signal. The end result? Mental fatigue, overtrading, and often losing money. Swing trading requires you to pause and zoom out. Look at the bigger picture, because that's where the strength of swing traders lies. They're not trapped in the noise of small charts. They focus on major trends, key areas, and setups with the potential to generate significant profits over the medium term. Let's discuss why you should start getting comfortable with larger time frames, such as 4 hours, H4, 1 day, D1, and even 1 week, W1, if you want to become a mature swing trader. 1. Larger time frames equals more relevant trends. If you only look at the 15-minute chart, you might see that ETH prices are rising. But when you open the daily chart, it turns out ETH is still below the main resistance line that has held for 6 weeks. So the question is, are you following the trend, or are you caught in a false breakout? Larger time frames provide context, and context is the primary tool of a swing trader. By knowing the direction of the larger trend, you can determine buy positions more accurately during pullbacks. Know whether you're entering against the trend or following the momentum. Avoid entering in areas prone to fakeouts or market manipulation. Real-life example. You see BTC up 3% today and feel FOMO. But on the weekly chart, the candle formed is a lower high within a downtrend. If you jump in because of the green candlestick on the 15-minute chart, you might end up buying at a temporary peak and get stuck for weeks. 2. Larger time frames help you identify key areas. In swing trading, you don't need 20 indicators. Clear support resistance levels, logical trend lines, and maybe 1 or 2 confirmation indicators like RSI or EMA, that's enough. And the best way to find these key levels? From larger time frames. For example, if you see Matic bouncing off the 60 cents area 3 times over the past 2 months, that indicates strong support. If the price approaches that level again, you can plan a swing entry there. You can target the previous resistance area, and boom, you have a solid trade plan. Smaller time frames often show noise, random movements that aren't significant. But on the daily or weekly charts, you see a much cleaner structure. You can assess whether the price is forming higher highs, lower lows, or just consolidating. Swing traders aren't fortune tellers. They just read recurring patterns, and larger time frames clarify those patterns. 3. Reducing stress and overtrading. When you trade on small time frames, you're prone to emotional triggers. Every candle seems to determine the life or death of your portfolio. But that's not necessarily the case. In swing trading, you don't need to enter every day. Even in a week, there might only be 1 to 2 setups worth taking. And that's good, because you're not looking for many positions. You're looking for high-value positions. By looking at the 4H or 1D chart, you can focus on quality setups. Step away from the screen without feeling guilty. Avoid FOMO because the market is always moving up and down in small time frames. On the other hand, if you check the 5-minute chart too often, you'll get caught up in the illusion of opportunities. But often, it's just noise. As a result, you'll open positions randomly, change strategies midway, and end up frustrated because profits aren't consistent. 4. Combine multi-time frames for precision. Even though we focus on larger time frames, that doesn't mean we ignore smaller time frames. In fact, professional swing traders typically use multi-time frame analysis. Here's how. 1. Identify the main trend in the larger time frame. For example, D1 shows a strong uptrend. 2. Determine key levels or pullback areas, valid support. 3. Look for entry confirmation on smaller time frames. For example, on H4 there is a rejection or bullish engulfing pattern. This way, you can enter with greater precision without sacrificing the main trend direction. It's like a sniper. You already know where the enemy will appear, and you just wait for the right moment to pull the trigger. 5. Support tools for swing traders. Here are some tools you can use when observing large time frames. EMA 50/200 to see medium and long-term trends. Volume profile to determine areas of accumulation and distribution. Weekly RSI to find out whether an asset is overbought/oversold. Fibonacci retracement from swing high to low to identify potential pullback areas. Trend lines and channels to visualize price movements within trend structures. However, remember that tools are merely aids. What matters most is your mindset and patience in following the setups you create from larger time frames. Conclusion of Chapter 1. If you want to become a skilled swing trader, you must stop treating charts like slot machines. Start treating charts like maps. And a good map cannot be viewed through a magnifying glass. You must step back a few steps and see the entire path. By getting used to analyzing charts from a larger time frame, you won't just avoid silly mistakes that get you stuck, but you'll also find patterns, levels, and setups that are much stronger and more convincing. Swing trading isn't for impulsive people, but for those who want to learn discipline, patience, and strategic thinking. This is a very powerful approach. Chapter 2. Prepare mentally. Don't check your P&L too often. One of the biggest enemies of a swing trader is not the market. It's not red candles. It's not even FUD news that goes viral on Twitter. It's your own mentality. Yes, a fragile, undisciplined, and easily panicked mindset is the most deadly poison in the world of swing trading. And unfortunately, this poison can't be seen on the chart, but its effects can be very real. You close positions too quickly, change plans midway, or even cut losses even though the setup isn't invalid yet. All of that happens because of one thing. You check your P&L too often. 1. P&L is volatile, not final. Let's start here. When you're swing trading, the positions you open can last for days, even weeks. During that time, it's perfectly normal for your position to go from floating profit to loss, or vice versa. This is normal. But when you keep opening the app and watching the numbers fluctuate in the P&L, your mind becomes unstable. Today it's green, tomorrow it's red. Happy in the morning, stressed in the afternoon. Your emotions are like a roller coaster. And that's when temptations usually arise. Wow, already up 8%. Let's take it now before it goes back down. Oh well, it's only down 3%. Let's just exit. Maybe we can re-enter at a lower price. Why does it keep dropping? Let's just switch to another coin. In reality, all those decisions aren't based on analysis, but on fleeting emotions triggered by constantly watching the P&L numbers. Swing trading requires you to be patient. To trust the plan you've laid out from the start. Not to waver just because the numbers change from green to red. 2. Prepare mentally before entering a position. Before you open a swing position, you must know that the price may fluctuate before reaching the target. This is extremely important. Don't enter a swing position expecting the price to rise straight up without any obstacles. That's a fantasy, bro. Therefore, before entering, you must agree on these 3 things. 1. How much risk are you willing to take? For example, 3% of your total capital. This means that if the price drops to that point, you're willing to cut losses without getting emotional. 2. Where's the invalidation level? This is the point where your setup is considered technically failed. This serves as the benchmark for your stop loss. 3. What is your target and within what time frame? Don't enter a position without knowing where you want to exit. Set your take profit level and patiently wait. By answering these 3 questions, you establish psychological boundaries. You no longer rely on daily P&L figures because you know that true profit lies at the end, not along the way. 3. Build mental resilience against FOMO and doubt. One of the toughest temptations for swing traders is seeing other coins rise faster and being tempted to switch. This is a trap. For example, you're holding a swing position in SUI, which has already risen by 6%. But when you see RNDR rise by 15% in a single day, you panic. Oh no, I'll lose out if I don't switch. So you close your position in SUI, enter RNDR, and boom, RNDR drops, while SUI continues to rise by 20%. This habit of jumping around makes you feel like you're always falling behind, and it becomes extremely difficult to maximize profits from a single swing. In fact, big profits often come from holding a position longer than your fear allows. Remember, a skilled swing trader isn't the one with the most entries, but the one who's most patient and waiting for results. And to be patient, you must be immune to FOMO and market temptations. Hold on. Focus. Trust your own analysis. The crypto world always has coins that seem to rise faster, but you can't chase them all. Choose one and ride it patiently. 4. Avoid too much discussion after entry. After opening a position, many traders spend too much time hanging out in Telegram or Twitter groups. They keep seeking others' opinions. This is dangerous. Why? Because sometimes you start doubting your own decisions. You entered a swing trade on ARB because you saw a breakout on the daily chart. But an influencer says ARB is overvalued. Then you start doubting. See a little red P&L, panic, cut losses. And 2 days later, ARB surges over 25%. You weren't wrong in your analysis, but you doubted because you listened to too many other voices. A skilled swing trader is confident in their analysis. It doesn't mean being stubborn, but they know when to listen to feedback and when to keep their mind clear. Simple tip: after entering a swing trade, avoid the noise. Don't frequently open public discussions about the position you're holding. Save it for personal evaluation later. Focus first. 5. Reduce interaction with charts and apps. The most effective practical step: remove the app exchange shortcut from your phone's home screen. Don't let yourself open the app and check P&L every 10 minutes. Use price notifications or alerts on TradingView if you want to know whether the price has reached your target or stop loss. The rest? Leave it alone. Don't fiddle with your position. Swing trading isn't about constant intervention. It's about letting the plan run its course without interference. The less you check your P&L, the more stable your mindset will be, and the greater your chances of achieving optimal profits from a setup. Chapter 2 Conclusion. Swing trading isn't just about technical strategies. It's a battle with your own mindset. You must dare to trust the plan, hold the position, and not be swayed by emotions every time the numbers change. Don't check the P&L too often. Don't be tempted to switch coins just because others seem to be rising faster. Don't change the plan just because of one red candle. A strong mindset is built through discipline, from experiencing losses and still being able to learn, from believing that you don't have to win every position, but must consistently follow the system you designed yourself. Skilled swing traders are those who can withstand uncertainty without panicking, those who can be patient without expecting instant results. And that's what you're building right now. Chapter 3. Pay attention to fundamentals and macro. Many novice swing traders focus too much on charts, candlesticks, and technical indicators, forgetting one important thing. Prices in the crypto market are not just about lines and numbers, but are also influenced by the real world. Yes, macro and fundamental factors are two elements that can quickly shift market direction, and this is crucial for swing traders. Why? Because you hold positions longer than day traders. This means you must be prepared for significant changes that may not be visible on the chart, but can have a substantial impact on the trend's direction. If you don't pay attention to macro and fundamental factors, it's like sailing a boat with your eyes closed. The wind could change direction, waves could come, and you might keep rowing in the wrong direction until eventually your boat sinks on its own. 1. Macro determines the medium-term wind direction. What are macro factors? Simply put, these are the major factors that influence the entire global market. Examples include central bank interest rates, such as the Fed, inflation, CPI, PPI, labor market data, and unemployment rates, geopolitical conditions, war, sanctions, international tensions, global risk sentiment, risk on or risk off. All these factors play a role in determining whether investors and traders are willing to take risks, such as investing in crypto, or opt for safe haven assets like the USD and gold. For instance, when the Fed announces it will lower interest rates, the market typically reacts positively. Why? Because lower interest rates encourage investors to take risks and seek higher yields, and crypto can be a safe haven. Conversely, when inflation rises or global political tensions escalate, investors tend to avoid risky assets. As a result, crypto prices can plummet, even when they look technically sound. Therefore, as a swing trader, you can't ignore macro news, because it's possible that the position you've patiently held for a week suddenly becomes invalid just because Jerome Powell coughs twice. 2. Project fundamentals equals how strong you can hold on. In addition to macroeconomics, you must also pay attention to the fundamentals of the crypto project itself, because in swing trading, you may hold a position for several weeks. If the project you're holding turns out to be empty, has no progress, or even gets embroiled in a scandal, the price can plummet without mercy, and you won't have time to exit. Fundamentals you need to pay attention to include project roadmap and deliverables. Are there any important events like a mainnet launch, staking program, or major upgrade? Team and backing. Who is behind the project? Are there major investors like A16Z, Binance Labs, or Coinbase Ventures? Volume and liquidity. If the volume is low, the price can be easily manipulated, which is high risk for swing traders. Community and adoption. The more people use it, the higher the likelihood of price stability or growth. Real-world example. When Arbitrum, ARB, announced a major airdrop and scaling update, the ARB price rose consistently over several weeks. Swing traders who knew about the event and entered at the support level before the announcement could have made significant profits without excessive stress. Conversely, projects that are quiet or plagued by internal drama, such as developer conflicts, often result in prolonged sideways price movements or even sudden crashes. Therefore, don't swing trade a coin just because the chart looks good. Also consider the fundamentals. 3. Combine technical and macro analysis. This is the skill that distinguishes ordinary swing traders from professionals. The ability to combine chart analysis with macro and fundamental understanding. For example, the BTC chart shows strong support at $58,000, technically equals entry signal. Then you see the Fed has just signaled a dovish stance equals positive sentiment. At the same time, BTC dominance is starting to decline equals potential alt season. Combining these three elements can serve as the foundation for your swing entry. It's not only technically valid, but also supported by macro context and market momentum. Or the opposite. The chart looks good, but suddenly CPI data is released with numbers higher than expected. The market drops due to expectations of interest rate hikes. If you're unaware of macroeconomics, you'll be surprised and panic. But if you understand macroeconomics, you know this is systemic risk that can invalidate all swing setups. So in the real world, charts don't exist in a vacuum. They react to the reality outside. And as a swing trader, you must bridge these two worlds. 4. Tools to help you stay updated on macro and fundamental news. Don't worry. You don't have to be a Bloomberg analyst or an economic expert to understand macroeconomics. All you need are simple tools to stay updated. Here are some you can use. For macro and global news. Investing.com, CPI data, PPI, Fed announcements, etc. forexfactory.com, real-time economic calendar. Bloomberg/Reuters/CNBC, latest macro headlines. For crypto fundamental projects. CoinMarketCap, project events and updates, launches, airdrops, etc. Messari.io, fundamental data and analysis of crypto projects. Twitter/X, follow trusted developer and analyst accounts. DeFi view TVL and liquidity trends. You don't have to check all of these every day, just 2 to 3 times a week while monitoring market conditions. Get into the habit of having context before entering a trade, rather than just looking at charts and jumping in without thinking it through. 5. Don't swing trade during periods of high uncertainty. This is the ultimate tip. Avoid opening swing positions when the market is facing major events that could cause extreme volatility. Examples: Federal Reserve interest rate announcement, FOMC, CPI release, U.S. monthly inflation, geopolitical updates like Middle East or Asia conflicts, important votes in project communities, governance proposals. Why? Because a setup that was valid can become invalid instantly due to drastic shifts in sentiment. It's better to wait for the data release or event to conclude, then assess the market direction. Only then swing trade under more stable conditions. Swing trading isn't about speed, but about accuracy, and your timing can be more precise if you avoid such chaotic moments. Chapter 3 Conclusion. Being a swing trader isn't just about indicators and candlesticks. You need to level up, start understanding that medium-term trends are heavily influenced by the real world outside. Macro and fundamental factors are the two winds that determine the direction of your sales. Traders who rely solely on charts will always be left behind. But traders who combine charts with macro logic and fundamental understanding will be far better prepared to handle market surprises. Remember, you don't have to know everything, but you must know enough not to be fooled by noise and not get trapped in the wrong position. By paying attention to macro and fundamental factors, you're not just seeking profit, you're building resilience. And resilience is the key to a successful swing trader. Chapter 4. Pay attention to risk management. No matter how strong your trading strategy is, no matter how perfect your entry setup is, one thing you must always keep in mind as a swing trader is risk management. Without it, all your planning is just empty hope that can be undone by one impulsive mistake. If you think swing trading is just about following trends and holding positions, you're only halfway there. The other half, and this is often overlooked, is how you manage losses when the market doesn't go as expected. 1. Swing trading equals greater potential rewards, but also greater risks. The most fundamental difference between scalping/day trading and swing trading is duration. Scalpers can enter and exit positions within 15 minutes. Day traders might hold positions for 1 to 3 hours. But swing traders? They can hold positions for 2 to 14 days or even longer. The longer you hold a position, the greater the price movement potential. And this means you can achieve significant rewards, 10% to 50% or more per position. But you also have to be prepared to bear wider losses if the trend reverses. That's why swing risk management cannot be equated with day trading. For example, while day traders typically risk 1% per position, swing traders are usually more lenient, 3% to 5%, provided that the setup is mature and the potential reward is commensurate. The key point is that swing risk isn't about how much you can lose, but about how much you're willing to lose and still be able to continue trading. 2. Determine position size based on total capital and risk tolerance. Most beginners get stuck on the nominal amount. If I want to make a profit of 1 million, I need to invest 10 million. But you should think like this. If I enter with 10 million, what percentage of my capital am I willing to lose if the setup is wrong? That's what's called position sizing. It's a fundamental principle in risk management. 1. Determine the percentage of risk per position. Swing trader recommendation, between 2% to 5% of total capital. 2. Determine the stop loss based on the chart structure. For example, if the support level is at 90 cents and you enter at $1, then SL equals 89 cents. 3. Calculate the position size based on the distance between the SL and the risk you're willing to take. If your capital is 10 million and you're willing to risk 3%, that means you're prepared to lose 300,000. Therefore, the position size equals 300,000 divided by entry, stop loss. With this calculation, you no longer guess the position size. You enter the market with full awareness of the risk you are taking. 3. Use a risk-reward ratio of at least 1 to 2. A simple yet powerful rule. If you are willing to lose 3%, then you must aim for a profit of at least 6%. That means your risk-reward ratio is 1 to 2. And this is the minimum. Why? Because in swing trading, you won't win every position. Even professional traders only win 50 to 60% of their positions. But with a healthy risk-reward ratio, you can still make significant profits even if you lose more often. Simple simulation. 10 swing positions. 5 losses. 3% loss x 5 equals minus 15%. 5 wins. 9% profit x 5 equals plus 45%. Total profit equals plus 30%. See, the key isn't a high win rate. It's consistent risk-reward. 4. Never change your stop loss after opening a position. This is a classic mistake that can often be fatal. You set your stop loss at 95 cents. But when the price hits 96 cents and drops, you panic and move your SL to 90 cents. Then it drops again to 89 cents, and you say, hold on, maybe it will bounce back. Eventually, the price drops to 75 cents, and you're stuck for 3 weeks. A stop loss isn't just a feature in the app. It's a psychological boundary you've set for yourself. If you change that boundary, you're no longer a swing trader. You're gambling and hoping for luck. Discipline with stop losses shows you can accept losses calmly. And this is a rare quality possessed only by true swing traders. 5. Don't go all in. Keep some capital in reserve. Since swing trading takes longer, it's best not to use all your capital on just 1 or 2 positions. Use a capital allocation system. For example, 60% of capital for active positions, 20% of capital kept for averaging if needed, and the setup remains valid. 20% of capital kept in cash for new opportunities. Why is this important? Because the crypto market moves quickly. Often, good opportunities arise while you're holding other positions. If all your capital is tied up, you can only watch from the sidelines. Additionally, capital reserves are important to avoid psychological overattachment to a position. If you go all in, you tend to become too emotional, because one position determines the success or failure of your portfolio. That's dangerous. Wise swing traders always have a backup, because what they aim for isn't just one big profit, but consistent profits from many measured opportunities. 6. Create a risk journal and evaluate. This is a rarely done but very powerful step. Record all your swing positions and evaluate them weekly. Write down entry and exit levels, reasons for entering the position, risk-reward ratio taken, whether you adhered to the plan. Final result, profit/loss. From here, you can determine, are you too aggressive, taking profits too quickly, or frequently moving stop losses? With this data, you can gradually improve your system, and you'll be surprised at how much improvement you can achieve simply by consistently recording. Remember, swing trading is a game of patience and long-term learning, and your journal is your tool to get better week by week. Conclusion Chapter 4. Risk management is not an afterthought. It is the cornerstone of swing trading. Without it, all those beautiful setups are just empty hopes that can crumble under emotional pressure. With sound risk management, you can not only survive losses, but also be ready to win in a measured way. Never underestimate the value of small stop losses, discipline with SL, and smart capital allocation. These aren't signs of weakness. They're the hallmarks of a true trader's strength. Successful swing traders are not just skilled at entering trades, but also know when and how to accept losses without panic and manage wins without greed. Swing trading isn't just a style, it's a way to survive in the crypto world. In the fast-paced world of crypto, we sometimes think that the only way to survive is to be super active. We have to constantly monitor charts, follow every breakout, and open and close positions like parking attendants. But the reality is, that's not everyone's style. And for some people, including you, perhaps, it can be the fastest way to burn out, not break out. Swing trading comes as an alternative, not because you're lazy, but because you choose to be more strategic. Not because you're afraid to take risks, but because you want to take risks worth taking at the right time, with a mindset ready for battle. Becoming a skilled swing trader isn't about predicting whether prices will rise or fall. It's about being able to combine technical analysis, macro understanding, project fundamentals, emotional control, and risk management into a balanced package. And this isn't an instant skill. It takes time, practice, and above all, discipline. So if you're still prone to panic when looking at your P&L, or still jumping from one coin to another due to FOMO, relax. That's part of the process. All great swing traders have stumbled along the way. What sets them apart? They keep learning, keep evaluating, and keep honing their mental resilience, sharpness, and patience. From now on, you're not just a seasonal trader. You're training yourself to become a strategic thinker, someone who isn't swayed by temporary red numbers, but focuses on the bigger picture and emerging trends. Remember, swing trading isn't for those who want to get rich quick. It's for those who want to survive and grow in a brutal market. And if you're consistent, you'll get there. One swing, one strategy, one lesson at a time. 5 core rules from Mr. Suw Crypto, varied versions, but still aligned with the core principles. 1. Never enter the market with money that keeps you up at night. Cold, hard cash is the foundation, not an option. 2. Don't insist on using high leverage just to satisfy a desire for revenge. What you're defeating is the market, not your own emotions. 3. Build a balanced portfolio, majority in BTC, the rest in clear altcoins. Don't chase random coins without direction. 4. Always keep a cash reserve. Dip isn't a signal, it's an invitation, and you can only attend if you have ammunition. 5. Play the long game, not the short game. Crypto is a marathon, not a 100-meter dash while guessing the wind direction. That's all for this episode. If you like content like this, don't forget to follow and share this podcast with fellow chart warriors who want to learn without all the jargon. And for those of you on YouTube, give it a like, comment on your favorite coin for swinging, and of course, don't forget to subscribe. See you in the next episode. We'll dive deeper into topics, but still keep it light and easy to digest over a cup of coffee. This is Mr. Suw Crypto, and remember, it's not the fastest who wins in the market, but the most disciplined and resilient. Peace and profit.